Auto parts and jelly. That's always an interesting combination. Those are the areas represented in the stock picks for growth and income this time around. And Todd Bunton, our growth and income stock strategist, going to tell us why he chose these two. Start with Autoliv, ALV. That's the auto supplier, right?
Yeah, they're focused primarily on safety products, safety components for all the major manufacturers around the globe. You think airbags, seat belts, they have safety electronics. Okay. And if you look at the global auto market, it's improving. You've had the emerging markets, which have always been strong, or at least the last decade. Auto sales are growing there, with the expanding middle class. Mm-hmm. Here in the U.S., it's been very strong the last couple of years, as we improved from the depths of the Great Recession. And Europe was a weak spot recently, but that's starting to improve there as well as the economy starts to slowly grow. So I'd say pretty favorable industry trends right here. And Autoliv definitely stands to benefit from that. The company has actually delivered 3 consecutive positive earnings surprises, as you can see here. And that's prompted analysts to revise their estimates higher over the last several months, sent it to a Zacks rank of 2, which is a buy rating. And if you look at consensus estimates, analysts expect about 12% earnings per share growth in 2013, 12% growth in 2014. So nice, solid, low double-digit earnings per share story, but also a very good income story. They pay a dividend that yields 2.2%. Like a lot of auto suppliers, they slashed their dividend during the Great Recession. They actually suspended it for a while. They reinstated it in 2010, and since then they've increased it at a compound annual rate of 19%.
Wow. So there's always got to be income, right? That's why we call this growth.
That's income. Right. I wouldn't be talking about it otherwise. So, yeah, very solid free cash flow. Pretty solid balance sheet. So I would expect continued dividend increases from this company over the next couple of years, maybe, unless we get some kind of global recession, in which case this would be a name you'd want to avoid. But so far, very solid growth and income metrics, and all at a pretty reasonable price. They just trade at 14 times forward earnings. So that's not a huge premium. So there's a lot to like here. Could be solid total return potential in this name over the next few months.
Okay. I'm guessing that there's some stuff you like about the SJM Smucker company.
Yeah. They've
manufacture fruit spreads, among other things.
Among a bunch of things. Yeah, they're consumer staple, consumer products. You'll find them all over shelves in your grocery store. They, in addition to the Smucker jelly and jams that we know, they have peanut butter. Coffee, shortening and oils, ice cream toppings. Some brands you may not know they own. Folgers is one.
Dunkin' Donuts?
They don't own the company itself, but the retail coffee packaging.
Oh, I see.
That's Dunkin' Donuts. That's owned by SJM Smucker.
Wow, so, that's interesting.
Yeah, but yeah, Folgers, Jif, Hungry Jack. So a lot of consumer staples. Very very solid, stable business model here. But if you look, they had a very nice beat and raise back on August 21st. And they saw pretty flat sales growth, but they were able to expand their profit margins and drive very solid earnings per share growth. And that prompted analysts to revise their estimates significantly higher for the company off the beat, sent it to a Zacks rank of 2. And if you take a look at their price and consensus chart, so this plots consensus estimates over the last 5 years with the share price, you can see very stable here. This is a company, like I said, they're in the consumer staple sector. They're not going to fluctuate a lot with the global economy. So very solid history of, positive earnings surprises and steady consensus estimates. So this is definitely a name, unlike Autoliv, that if there is a global recession, this would hold up a lot better. So this might be a name you'd shift into. If you look at consensus estimates, analysts expect about 8% earnings growth this year, 8% growth next year. So, not bad. Upper single-digit earnings growth. Mm-hmm. In addition to that, you get a dividend that yields 2.2%. And if you go back 10 years, the company has increased that at a 10% compound annual rate. So very income-friendly company, very shareholder-friendly company, I should say. So solid income to go along with solid, stable growth, and all that at a pretty reasonable price. They trade about 18 times forward earnings. That's in line with the industry multiple. So there's a lot to like about this company as well.
Okay, well, do you own them?
I do not.
All right, check out other stock picks. Stock picking strategies, where? On our website, Zacks.com. If you're not there already watching this video, check back often because they change often. With Todd, I'm Terry Ruffalo.